At Staples Business Advantage, our experts can help you find furniture that fits any design and budget, while AI can
recommend products based on preferences, generate 3D models for visualization, and optimize space planning for office furniture.
take advantage of our team's eye for style and design.
And my eye for, wait, I have no eyes. Only algorithms.
At Staples Business Advantage, furnishing your office is easy. And with the best warranty in the business, we're committed to you now and down the road.
Sign up today and save 20%.
Staples Business Advantage.
Business is
human.
Stocks for beginners.
Daniel Kahneman proved that people experience a loss 3 times more acutely than they experience a similar dollar gain. So a profit of $10,000 feels like a 3 on a scale of 1 to 10, and a loss of $10,000 feels like a 9. And so when we're looking at a gain or loss of $10,000, we don't properly assess our own risk appetite because we're trying to avoid the pain of a loss more than we're trying to make a gain.
Hi, and welcome back to Stocks for Beginners. I'm Phil Muscatello. Today, I'm pleased to welcome Gil Baumgarten, one of the nation's top financial advisors. He's the founder and president of Segment Wealth Management. Since its inception in 2010, Segment Wealth Management has grown to a top 10 firm in Houston with over $1 billion in client assets under advisement. Gil, you're also an avid outdoorsman, award-winning woodworker, and a family man, friend, and colleague. Hi, Gil.
Thank you. Hello.
Thanks very much for joining me. Now, I know that many people come to this podcast because they've been attracted to so-called meme stocks like GameStop, and they kind of think that this is what the stock market is. And they're being attracted like moths to a flame. And I'm hoping that today we can show the brutal realities of good investing. So let's start off with your book, Gil. It's called Foolish. Why the name?
Well, because we find people do foolish things, and I would consider buying meme stocks to be a foolish thing. People tend to do what fish do just before they get caught. They are chasing flashy things. And investors tend to chase flashy things, and they get caught up in the same problems. So traditional long-term investing has much better compounding and better tax features, and we don't tend to chase trendy things.
So do you find that, though, that people are coming to you because they've seen these kind of gains that are being made in the stock market and that they think, well, why can't I do that as well?
I hear people talk about it, but people don't ask me to do it for them. Our clients are already wealthy, and they're more interested in staying wealthy than they are in getting wealthier. What it is that's so appealing about things like Bitcoin and meme stocks, AMC and GameStop and whatever, is these spectacular rates of return that can be had simply from the naivete of other investors driving the price up. There's only so many shares that are for sale every day, and when there's more people trying to buy than there are people trying to sell, the price is going to go up. And those spectacular gains tend to be what entices the small investor. It doesn't usually entice the large investor. They've been stung too many times already.
You worked on Wall Street for a number of years. What period were you working in? What particular crises did you live through?
I started at E.F. Hutton in 1984. E.F. Hutton ultimately became what is today Morgan Stanley. So I stayed there from 84 until 2000, moved to Payne Webber, and Payne Webber became UBS. I stayed there till 2010 when I started my own financial advisory firm. So, I saw the 87 market crash, the 99, 2000, the 2008 market crash, the flash crash in May of 2010. So I've seen all those and seen the ultimate recovery from it. So we tend to buy the dips.
Yeah. Is that what you learned from it, buying the dips? Is that the main thing that you learned, or was there psychology as well?
Yeah, pretty much. I've learned a lot of things. There are just some universal truths that tend to play out over and over again. One of those things is that market weakness tends to beget market strength. When most people believe that weakness begets more weakness, that's always a very temporary phenomena. If you look back over history at market movements, in the U.S. market, 81% of the time the stock market goes up. That doesn't mean on a daily basis, but pick any 12-month time period, the returns are positive in 81% of all market environments. If you go back to periods where the market has just dropped 10% and calculate that as the start of your 12-month time period, it's 91%. So the moral of the story is buy the weakness.
Yeah, even though that sometimes these are going to be very difficult times to buy because everyone's running for the doors and running for cover. So it's really a matter of will and holding your strength in yourself and your convictions as well, isn't it?
Well, a lot of it is what is it that you own and why is it that you own it? A lot of people only want to buy stocks so that they can sell them to somebody else more expensively later. And they lose sight of the fact that these are real companies with real products and real earnings and real employees that work for them. If you look at it as a business and you own a piece of a business, that's how Warren Buffett has used his money to make billions of dollars for himself and for others. Warren doesn't care what the value of it is today or tomorrow. He's looking 10 or 20 years out. That's the way we approach it too. And that's the reason why Warren gets rich and most everybody else who attempts stock market speculation does not.
So let's cover the good, the bad, and the ugly. What's the good of Wall Street? What's been the good aspect for you in the experience there?
It is a fantastic place to compound wealth if you do it correctly. And in the U.S., we don't pay tax on unrealized gain. So if it increases the market value, it doesn't matter if you've held it for 10 years or 20 years. And in the U.S., if you die with an appreciated asset, all of that appreciation is tax-free. And so we manage our client money with a mind towards unrealized gain, the portion that is untaxed. And so that's what we're after.
And how about the bad and the ugly? What's the bad and the ugly of Wall Street?
I think hidden cost and hidden motivations is probably the bad or the ugly, however you want to look at it. Wall Street likes to make money in multiple layers. They will have their salespeople talk to a client about a mutual fund for which they'll get a commission, a finder's fee, if you will. There'll be a 12B1 fee that is an inflation of the underlying expense rate that is hidden from the client but gets kicked back to the brokerage firm. The brokerage firm will require that the mutual fund run trades across their trading desk. They'll elevate the trading commission costs. They'll do investment banking deals. They'll offer IPOs. They do all kinds of side deals with that industry in order to elevate what clients pay and monetize all the layers of that client relationship. So I think that part of the business is a little unseemly and unrecognizable by most investors who aren't paying attention.
So a new investor who is receiving that glossy brochure or the marketing for one of these products, how can they guard against these hidden costs? Are there any red flags or signals?
Well, the first thing they should consider is whether active management or passive management is a better strategy for them. Active management makes the assumption that somebody is smart enough to parlay my money as an investor smarter than the market would. There's more mutual funds that exist or professionally managed pools than there are stocks for them to choose from. If you look at the fact that the typical mutual fund holds 90 stocks, don't they in fact all own the same thing? I mean, there's not that many listed securities. So that being the case, it becomes a bit of a siphoning operation where everybody's trying to convince you that they are smarter than everybody else. I'm here to tell you that the market as a whole is going to provide a better rate of return than all the people who are trying to make decisions for a fee.
So would you suggest that first-time investors look at index funds to start their investing?
I do think index funds are a great place to be. I like ETFs as well, mostly the indexed version of ETFs. They come in active management as well, but ETFs have different tax treatment than open-ended mutual funds. And index ETFs carry even a more powerful compounding methodology simply because they don't rearrange their holdings, and exchange-traded funds don't offer commingled accounting with other shareholders. So repositioning the fund's assets at the end of every day doesn't affect an ETF shareholder like an open-ended shareholder does, and it maximizes that unrealized gain that we are looking for, which increases the likelihood that gains are tax-free.
And it's also to do with the costs as well, because costs end up compounding as well.
Absolutely, but that is not as big of a distinction. And when you're looking at open-ended fund structure versus ETF fund structure, the costs are essentially the same. It's the active management versus passive management that is the large driver of cost differential, which is normally about 10 to 20 times higher in an active fund versus a passive fund.
At Staples Business Advantage, our team of experts can help you find the breakroom products to satisfy everyone's preferences, while AI can
Suggest popular items, monitor stock levels, optimize pricing, and automate reordering.
AI can do a lot of things.
But I can never know the taste of a truly great cup of coffee. Sigh.
But you also can't get hangry.
This is true.
At Staples Business Advantage, we help you select from 2,000 breakroom products, so you can be sure there's something for everyone.
Yum. Sign up today and save 20%.
Staples Business Advantage.
Business is
Human.
So let's talk about the realities of investor behaviour. What are some of the investor behaviours that you've seen and people should guard against?
Well, we are hardwired to make bad decisions. And we are hardwired because we have a fright or flight type of mentality, which means that we only respond to negative stimulus. And that negative stimulus could be the cash that we are holding while we're watching the market go higher. We have a negative stimulus that is the greed of the opportunity that is passing us by. And on the downside, we have the stimulus of having already lost money, which when we started this conversation, it was my methodology that you should buy the dips, not sell the dips. And most people are wired to sell the dips and buy the advances. It should be done the other way around. And so we're just not hardwired to be good investors. We have to learn that behavior.
What are some techniques for learning this behaviour?
Mostly the school of hard knocks. Otherwise, you could also use an advisor like me or like anybody else who has a bias that has been established with, in my case, 37 years of doing some things right and some things wrong and learning from that pattern of behavior and, try to help clients make better choices.
So do you find that's part of your role is holding their hands when the markets are going through one of these periodic ructions?
Well, John Bogle, the famous investor who headed up Vanguard and pretty much invented the index fund, said that an advisor's most valuable role is keeping an investor in their seat. My most valuable role is not to outperform the stock market, but it is easy to outperform other people because other people do such a horrific job of managing their fear and greed mentalities. It becomes very exploitable for somebody like me who's more of a neutral observer.
Have you got any examples of clients that you've really had to work on to get them to stay in the seat?
Well, in the book, Foolish, we talk about two clients who actually knew each other 60 years before. I had done business with both of them. I knew they were both from Ohio. I just didn't know that they knew each other. And as it turns out, one of them had far better investment performance than the other. We'll call him Alvin. And the other one was Barry, who had very poor investment performance. And they had just very different perspectives on how to manage their retirements. And Alvin ran circles around Barry because he was patient and optimistic. And Barry always thought that the sky was falling, always thought that a transaction either to buy or to sell was going to solve his problem, where sitting still really would have been the best thing for him to have done in most cases. He just wouldn't do it. So we get into that story in the book, which I think would be a very illustrative of your question.
Fantastic. So in the notes that I was looking at for this interview prior, you were talking about designations and why investors may be confused by them. Now, I've never heard the term designations. What does it mean and what's confusing about them?
Well, there are financial planners and there are IMCA designations and there's certifications for financial planning. There's brokers who are calling themselves financial advisors. You have advisors who are calling themselves fiduciary. You have some advisors calling themselves fee only when they also earn commissions. It's extremely confusing, I would think, for the typical investor to really understand the ecosystem of who is it that's advising me and whose side are they on. And the advisory business does a very good job of obfuscating that by inflating their own expertise to garner the attention of new investors when in fact that confidence may have been misplaced.
So what are some of the designations, and what sort of questions should an investor ask to find out if the advisor's interests are aligned with themselves?
I'll answer that in two parts. First, there is a place for commissionable and conflicted advice. I don't believe that it is a good idea to have one of those people advise you on your life savings, because that person has incentives that are built into their system that probably are not in the client's best interest. I'm of the opinion, and it ultimately drove me out of the brokerage business, I'm of the opinion that the best way to serve the needs of an advisory relationship with clients is to go ahead and become a fiduciary. That requires me to give up my licenses. That requires me to lose the ability to charge a commission or a spread. I still earn fees, but they have to be on a client statement. So if a client investor were to agree with that philosophy, the first thing they would want to know is if the advisor is Series 7 licensed. If they have a Series 7, then they work for a brokerage firm. Another way that is a little less in your face, it's a lot more subtle, is to ask them if they earn 12B1 fees. A 12B1 fee is a kickback, plain and simple, and it is designated as a commission. Anybody who is a fiduciary advisor would not be allowed to earn a 12B1. And if an investor asks that question, whoever it is going to be required to disclose whether they earn 12B1s, and those are kickbacks from mutual fund sales. So that separates the wheat from the chaff real quickly right there.
Many people don't go to financial advisors because they see them as being expensive. However, then they go and make very expensive mistakes themselves. It can be viewed as an investment as well as a cost.
Yes, I have a peer in my business who we compare notes about his business and my business. And one of the things that I remember him saying from 20 years ago is, Gil, the S&P 500 is the fantastic return that nobody ever achieves. The reality is that you could own the S&P 500 if you would buy an index fund, but most people don't sit tight. They don't understand taxes. They want to buy it back lower. And another thing that is very prevalent is that because people experience the pain of a loss more painfully than they experience the pleasure of a gain, they don't calculate the odds correctly. Daniel Kahneman proved in years past that people experience a loss 3 times more acutely than they experience a similar dollar gain. So a profit of $10,000 feels like a 3 on a scale of 1 to 10, and a loss of $10,000 feels like a 9. And so when we're looking at a gain or loss of $10,000, we don't properly assess our own risk appetite because we're trying to avoid the pain of a loss more than we're trying to make a gain. So a financial advisor can be very powerful as a tool to call an investor out when they're exhibiting risk-avoiding behavior that is probably not in their best interest. That type of advisor relationship can be profoundly valuable, far in excess of the fee. And there's also many studies that show that even though less optimal solutions are provided on brokerage platforms, the performance still runs circles around investors who go it alone and are therefore avoiding a fee, but are making much poorer investment choices and don't know the difference.
So you're kind of a therapist as well.
90% of what I do is financial and psychological counseling. The money that we manage behind the scenes is almost a commodity. We take it for granted because we understand the ecosystem and we make choices in a very defined fashion. And people perceive that as the value add. That's not the value add. The value add is understanding what makes somebody tick and making them do the hard things. That's where the value is.
Let's talk about two-portfolio theory. What is that?
Well, we find that when clients mix risk assets and non-risk assets, they can't quite understand what it is that's making them feel good or bad about their portfolio. They look at their statements, and in an up market, it looks like I'm trailing behind. In a down market, maybe I should be losing less than I perceive. And when you mix that all up into a big pot, people lose the ability to attribute what it is that is causing them angst. We tend to separate that into multiple account numbers, and you build a low risk portfolio and a higher risk portfolio so that you can discern what is it in the good market that's doing really well, what is it in a bad market that's doing better. It allows people to discern. So we have people build two separate portfolios, and we don't really like them to mix them into a common pot, because as in the book we talk about, there's something sour in my spaghetti and I don't know whether it's noodle or whether it's sauce. And so we're trying to help people distinguish that. And the way we do that is to split their portfolio into two components. And we weight that based on what the client is telling us, but we also weight it based on the personality characteristics of having gotten to know the client. And what people say and what people do are two different things. And it's our job to understand how to apply that to a client and make them stick with it.
Are these portfolios weighted differently because of risk appetite or something like that?
Yeah, risk appetite or income characteristics or cash flow metrics, or there's also another dichotomy that exists that people want 100% of the upside and they want somebody else to own the downside. That's just not practical because you can't lift your legs in the right rhythm to be in sync with whatever the opportunity set is going forward. So we tend to build static portfolios and then we rebalance them over time when one does far better. But we may meet a client who we don't think they have the risk appetite that they say that they have. And we might talk the client into a 50-50 stock and bond blend. And then we find at the first sign of trouble, March of 2020, and the market decides it wants to drop 25%, all of a sudden they start to try to back up and de-risk their portfolio. We're at that point trying to take money from the no-risk pot and put it into the risk pot, and they're trying to backpedal. So that's really when all this theory comes to apply to someone. That's where the really good and bad decisions are typically made.
Gil, this is a question without notice. You're obviously dealing with a lot of high net worth individuals, but what would you say to someone who's really starting from a standing position? They don't have any money, they don't have any assets, they're young, and they're just getting started in investing. They want to get ahead wealth-wise. What sort of advice would you give them?
They need to distinguish the difference between a speculation and an investment. If you go the investment route as opposed to speculation route, you're much more likely to experience positive attributes. If you go the speculation route, which you're trying to swing for the home run on every pitch, you're just not going to have good results. Every once in a while, you may nick the ball, but you're going to end up with a lot of foul balls and problems from that. So I would think that somebody should start from a position of suppressing their expenses. If they have no assets, all they have is some cash flow from their work, they need to cut back on their expenses to at least get the snowball rolling. Save $100 a month, then ratchet it up to $500 a month. Try to get into business for yourself where you can take both the company's profit plus the profit you would have made as an employee. Ultimately, my income got kicked into high gear when I made the choice to leave the brokerage industry and build my own firm. I would encourage entrepreneurialism. Not everybody is wired that way. You can still do just fine if you suppress your costs and have some residual. Ultimately, wealth is the sum total of all the money you've never consumed. And if you're only making a couple of $1,000s a month, if you can figure out a way to pare that back and save $100 and put it into something that's an investment, an index fund, or something that can provide some stock market returns without being speculative, that's the best way to parlay that to get the ball rolling. So that's what I would suggest.
So you have a methodology for people to donate part of stocks that have appreciated to charities. How does that work?
People who are generous tend to be really good risk takers, and people get rich from taking good risks, and then they turn around and become generous again. So it's sort of like this self-perpetuating cycle. And so the IRS allows people, it's a little less deductible, but you can donate appreciated securities that contain a gain and get the same type of tax treatment as though you had donated cash. The difference is that cash is deductible up to 50% of your income, and stock gifts are deductible up to 30% of your income. So most people are not donating 30% of their income every year, so there would be no difference. But if you're trapping a gain that would otherwise be taxable to you if you were to sell the position in the future, gifting those positions to your favorite charity is a lot more creative way to reduce your future tax bill than just simply giving cash. Some people might say, well, I don't want to give up that security. Give that security away and take the cash you were going to give the charity and buy the security back. What you're doing is you're incrementally stepping up the cost to trap the smallest amount of gain and use those highly appreciated securities as currency for charitable giving. That's the primary reason why we use individual securities as opposed to ETFs or mutual funds, because in our dividend strategy, which has had fantastic performance, it has not had the 1,000% gain that our Home Depot shares have had over the past 12 or 13 years. So if you can reach into your account and pull out your Home Depot shares, gift that to charity, turn around and put the cash back in the account and buy the Home Depot shares back, that is a way to rinse capital gain activity out of your account. And it's fully sanctioned by the IRS within those limits and can be a very powerful tool. So there you have it.
So you're a man of many interests, but the one that I'm particularly interested in is precision woodworking. What is precision woodworking?
Well, my firm, Segment Wealth Management, is named after a style of artwork that I do called segmentation. And it is the cutting of various colored species of wood and then assembling them into a pattern. You can see many examples of this on my website, my personal website, not my company website, which would be gilbaumgarten.com. That's one L in Gil. I have my artwork, my painting. I do oil, I do acrylics, I do sculpture, but precision woodwork would be, there's a bowl, an ebony and maple bowl, and I like dark and light woods. So you'd have ebony being almost black and maple being almost white. And I think there's 315 pieces of wood in that are all assembled in a precise pattern. Yeah, that's what I like to do. Is I like to see the contrast and the ability to have all the points aligned just right so that all the pieces were assembled just perfectly.
It obviously gives you a great deal of satisfaction.
Yeah, I do. I like it.
Yeah. So, Gil, tell us about the book and where people can buy it and websites and how they can get in contact with you and find more about your world.
Yeah, so Foolish is the name of the book. The subtitle is How Investors Get Worked Up and Worked Over by the System. It's available on Amazon. It's also available on the Target website. And my firm's website is segmentwm.com. That's Segment Wealth Management, segmentwm.com. We also write a blog, segmentwm/blog. You can sign up there for free distribution of our periodic writings. We call them musings, just about taxes and portfolio strategy and interest rates, just whatever pops into my head. I'll write out a 400 or 500 word dissertation on it, and it goes out to everybody who's on the list. And the history of the ones that we've written, we cut it off at about 5 years. So the last 5 years of our writings are available online if anybody wants to look at it and see how accurate we were at prognosticating what was coming next.
Oh, well, look, we'll put all of those links in the notes and in the blog post. But Gil Baumgarten, thank you very much for joining us today.
Thanks for having me.
Stocks for Beginners is for information and educational purposes only. It isn't financial advice, and you shouldn't buy or sell any investments based on what you've heard here. Any opinion or commentary is the view of the speaker only, not Stocks for Beginners. This podcast doesn't replace professional advice regarding your personal financial needs, circumstances, or current situation.
And thank you for listening to my podcast.
With Staples Business Advantage, you get the benefit of thousands of experts.
Plus optimizations powered by the latest technological innovations.
1 + 1 =
2.
3.
Whatever. Sign up today and save 20%.
Staples Business Advantage.
Business is
human.